In the previous episode, we went over the full timeline of the FTX situation. To summarize, Sam Bankman-Fried founded a cryptocurrency hedge fund and exchange worth $37 billion. It received investments from major players like BlackRock and celebrity endorsements, but in the end, it turned out to be a Ponzi scheme run in the Bahamas by Sam, his girlfriend, and a number of their friends. The disaster cost investors and clients billions of dollars, and when we last left Sam in the Bahamas, he was being watched by the police and tweeting about making amends to clients. But today we'll discuss some significant events that have occurred since then, including leaked texts, criminal investigations, and insider information on the entire scope of the company's disaster. After the initial shock of the bankruptcy and the outrageous stories leading up to it subsided, FTX's new CEO John Ray III carefully examined their finances. What he discovered was unbelievable. It was just a chaotic, fraudulent mess. John would write in his report that despite his 40 years of expertise, never in his career has he ever witnessed such a total breakdown of corporate controls, such a complete lack of reliable financial data, or such a concentration of power in the hands of such a small number of uneducated and potentially corrupted people. Given that John handled Enron's bankruptcy in 2001, it is safe to say that this circumstance is unprecedented.
CEO has talked about is how messy the accounting was. So keeping track of these assets, whether they're in Bahamas or in the U.S., and who has the right to really oversee those is one of the issues, and it goes back to the beginning days of FTX and sort of the mismanagement as John Ray has described it. And nobody really knows where the assets are at this point, so they're trying to untangle this web at the moment.
So what precisely went wrong? Hold on to your seats because things are about to get crazy. FTX didn't even know how much money it had on hand or how many people were there. Look at some of the highlights from the 30-page report, including those who even worked for the corporation. Number 1, a random boss would just emoji accept or emoji reject employee payment requests sent via chat. Number 2, Sam claimed that this was supposed to help the business grow and allow them to engage more with regulators, but in reality, $300 million of that money was siphoned off to him instead. Sam received a $1 billion personal loan from Alameda Research, and FTX raised $450 million from some major investors, according to the Wall Street Journal. Number 3, most decisions were made over chat, which were automatically deleted after a certain period of time, with a few records being kept. Number 4, FTX, a $32 billion firm, and the majority of its subsidiaries failed to hold any board meetings. Number 5, the amount of cash available at any given time was unknown to management, or even where all the money was at the time. Number 6, FTX failed to maintain accurate records of who they hired, and workers and contractors mixed with others across many businesses without any certain employees' time-tracking records are nowhere to be seen. Employees and executives utilize corporate monies to buy personal real estate, and they register the properties in their own names. Reports also claim that numerous of FTX's luxury residences are financed by the firm and were bought with 50 FTT and 50 FTX stock in the Bahamas. A further piece of news just in, Sam's parents and senior executives have spent $300 million on luxury properties in the Bahamas over the last 2 years. What's even worse is that Sam only recently claimed that FTX had $5.5 billion as of September 2022. The actual worth of those less liquid crypto coins in USD was merely $659,000. Therefore, a crucial question is, how did so many of the brightest people manage to do it? Aside from the fact that the financial sector is driven by a mania, people fall for this as well. Sam allegedly sent investors a paper that was too good to pass up because of the low interest rates and cheap money. A spreadsheet containing revenues, regular expenditures was used. Presented the impression that FTX was a fast-expanding company by omitting to mention Alameda. When it was created in 2019, the company had a healthy balance sheet, and its revenue increased from $15 million to more than $1 billion by 2021. However, because investors could only see dollar signs, they were drooling and wanted a piece of the action, despite the fact that these were sales documents without any accounting information.
Filing over the weekend showing the crypto exchange owes its 50 largest creditors more than $3 billion.
A number of celebrities, including Shaquille O'Neal and Tom Brady, are the targets of class action lawsuits against FTX and the promoters of their events. FTX entities maintain a deceptive platform as part of their Ponzi scheme, stated Adam Moskowitz in his lawsuit against the FTX entities in an attempt to maintain the appearance of liquidity by using new investor funds through investments and loans. In order to raise money and persuade American consumers to join in the Ponzi scam, it is further said that FTX uses some of the biggest celebrities in sports and entertainment. Some venture capital businesses, according to the news outlet's information, thinks of suing Sam as well. Sam Bankman-Fried is scheduled to appear before the U.S. House Committee on Financial Services at hearings on the FTX tragedy in December, while Joe Biden will demand for revisions to global Bitcoin and cryptocurrency rules on November 20, 2020. Maxine Waters, who will preside over the session, unfortunately seems to be friendly with Sam. The two met before the collapse in April 2022 to talk about cryptocurrency, among other things. Well, what about the potential for government corruption? In any case, it has just come to light that Gary Gensler spoke with Sam for 45 minutes in March about a new trading platform that the SEC was meant to approve. As a result, attorney John Deaton has filed a petition to look into the connections between Gary Gensler and Sam. People with knowledge of the situation have described this behavior as odd. And Fortune has reported that insiders in Washington, D.C. believe Gary will be interrogated by Congress and is allegedly sitting in a corner. Will the victims' money be refunded? That's the big question. That and whether anything actually comes out of this are both up in the air. According to Robert Frenchman, who works at the New York law firm, FTX customers will have to get in line with the rest of the creditors because there are no special protections for customers of unregistered crypto firms like FTX. There is not even a single document listing all the companies that deposited money, according to John Ray, who is currently reviewing Sam's Empire's books. In other words, things aren't looking good at all. Some folks might get their money back, but it's probably going to be cents on the dollar. Last but not least, Sam has sent some late messages to a Vox reporter, and he admits that his attempts to appear moral during the high points of the company were insufficient. Quote, "A dumb, woke game we Westerners play when we say all the right shibboleths, and so everyone likes us." He also said, "F regulators, they make everything worse." And after that, he accuses Caroline, who was in charge of Alameda, of being at fault. Sam's attorney Paul Weiss left him as a client after the collapse because he had been prattling so much, and I don't blame him, because Sam is currently almost impossible to defend legally. As for Caroline, there are allegations that she is eluding capture by going to Dubai, a nation without an extradition agreement with the United States, although these accusations are unproven at this time. In the end, they utilized emojis to discuss expenses in Sam's multi-billion-dollar empire, which is how it actually worked in the end. Sam secured a $1 billion personal loan. Additionally, important decisions were taken through chat and deleted. There were no board meetings, and neither the corporation nor its employees knew how much money they had. Other cryptocurrency organizations' collapses are expected to occur with Gemini, even though billions of dollars in consumer money were spent. Moreover, Sam was discovered last week wandering aimlessly in the Bahamas. According to news report, when they visited the location in August, FTX was displayed on an illuminated sign, but now that's gone. They also visited the offices of FTX, where the parking lot was basically vacant. Security personnel immediately shot them away. Additionally, they observed a car leave those buildings with 4 young people inside. But they were unable to confirm that they were FTX workers since they rolled down their window, avoided eye contact, and sped off swiftly. Give this video a thumbs up if you enjoyed our episode for today. That's it for today, and I believe I'll end the tale here unless some more significant news occurs that you guys would like to hear about, in which case I may make another episode.